So the market is changing, and it's not just about inflation or interest rates. It's rewriting valuations, reworking supply chains, and yes, reshaping your disclosures.
We're talking about what happens when market volatility meets materiality and why CFOs, GCs, and audit chairs are all paying attention.
Plus, we've got SEC signals, M&A activity, and what's been going on with IPOs the last few years.
Welcome to the pre-read. Just like the slides you get before a big meeting, the pre-read prepares you, CFOs, and other executives for the next big thing. It's the global podcast where finance, sustainability, audit, and risk come together in the C-suite.
If you're making decisions at scale or need to understand the leaders who are and what they're thinking, you're in the right place. This is the pre-read, and it's brought to you by Workiva.
I'm Steve Soder, accounting enthusiast and Diet Coke aficionado.
And I'm Melissa Zucker, sustainability nerd and equal opportunist caffeine addict. Later in the episode, we'll hear from Josh Gertsch, industry principal and IPO expert at Workiva, to discuss what's been happening with the market since 2020.
But first, we sat down with Nick Mazing at AlphaSense, and his three takeaways were the deal-by-deal approach to tariffs has created an unpredictable environment, and that's even for companies who are expected to benefit. Second, companies are moving beyond general references to AI and are being a lot more explicit about what they're building. And last, in addition to tariffs and AI, companies are talking about the effects from broader macro environments in a sometimes surprising way.
Let's go to our conversation with Nick. Let's talk about tariffs. They ruled the dialogue in Q1. You essentially could not read the newspaper across any major publication without seeing headlines and storylines. But then we didn't actually necessarily see a huge impact of those tariffs in Q1 earning releases. So what's been the general impact from tariffs in Q2 so far?
Funny that you ask. When you look at the S&P 500 earnings estimates in aggregate, there is no big revisions down. As a matter of fact, when you look at the aggregate earnings, they're slightly inflecting upward. So is the index, which is at around 6,000 as we record, they're expected to be around $264. But remember that around 30% of the value of the index is technology, which is not very affected by the tariffs. And then if you add financial services, around 15%, et cetera, services is probably well over 50%. And that is, broadly speaking, services as a sector have not been as affected. If you roll back the clock back in April, the level of tariffs that were announced was a big surprise. If you remember, the market dropped at around 20% pretty quickly when they rolled out that sign with all the countries that nobody had ever heard of and the numbers that they're getting. What we're seeing now is dramatically increased clarity with the recently signed EU deal, and the market is looking forward to more stability, whether it's China, whether it gets delayed or we come with some kind of a deal. But that's the financial market's perspective. They're seeing one-time bumping cost. This will eventually be passed on to consumers if you have studied economics. However, for now, we don't know exactly where they fall. If you look at the footwear marketer that reported last week, and they said there was no impact because they had already imported everything they needed, and they have already started increasing price. On the other hand, if you look at the GM and Stellantis, they reported over $1 billion each in hits because they had to absorb a lot of those costs.
So, Nick, let's unpack that just a little bit more then as far as what companies have actually said. It sounds like the impact hasn't been, at least in some areas, as severe as it might have been. But how are companies talking about them? In what specific ways are they showing up in results? And in part, I'm wondering, are companies just netting out the cost by passing them along to their customers, or are they just essentially taking it in the shorts?
It depends on the sectors. Companies are pretty explicit around tariff impacts when they have them. Even, let's say, Procter & Gamble, they reported around $1.50 in earnings last week. 3 cents of that was tariff impact. In some cases, even in places where a casual observer would not expect, such as, a beer company, because a lot of the aluminum cans are coming in from Canada, et cetera, they had a much more serious impact. And companies are saying that, hey, this is the impact. They're being pretty explicit about it in case they're absorbing the costs. In some cases where there is more market power, they've been able to either do as the suppliers to take the hit or have pushed price increases. But it's pretty messy because if you look at what happened, for example, with the automotive industry, the U.S. automakers are paying, I think, 50% on steel. When they announced the Japan deal, the Japanese automakers are paying 15%. So their stocks went up 10, 11%, I think, on the day that was announced. So who are we helping here, right? It's a similar situation with copper, right? There's like one US mine that produces copper. Like, how are you supporting construction or data centers and modernization and all of that? So I think it's that sort of deal-by-deal approach without whether there is a real strategy or not is creating, I think, it's pretty messy. But, as far as disclosures goes, it's pretty explicit, down to the penny in the case of earnings that I have seen.
And do you think that's maybe trying to avoid some of the political blowback by being really, really explicit and maybe not providing a whole bunch of context, as opposed to, hey, these are the impacts that we noticed. There it is, and maybe not saying any more or any less than that?
There is a risk around that because we've seen, unlike, let's say, the prior administration may not have necessarily called out a certain company. We're seeing that. And whether it's, we saw it with Home Depot, we saw it with Coca-Cola. I think companies are cognizant regarding the risk of being overtly critical. So it's more matter-of-factly. I don't think there is comments on, this is a mess. It's a mess. Everybody knows it.
Well, it would just seem like you're balancing what you just said, right? The risk of being called out and the political implications while still being able to provide the meaningful disclosures that investors or others are going to look at. I mean, that's walking a bit of a tightrope.
It is material, right? Like your favorite topic, Steve, materiality. It is material.
It sure is.
So you cannot just bury your head in the sand and, hope it passes through. It won't.
I want to go back and actually reflect for a second on that copper example you gave, because I think that's a really clear one to illustrate some of the practical questions that I think a lot of corporate leaders and frankly the general public had in the tariff policy, in that who are these tariffs really helping or who are they really impacting, right? If there's not a local domestic U.S. supply chain and infrastructure of copper mines, it's not where the copper is. It's not where we have that established industry. Putting that kind of tariff on that specific import good, not really helping the U.S. economy, frankly, or even that sector develop because it's complicated, right?
It's very complicated, and supply chains, don't get rebuilt in a few months. It's just not going to happen. Besides
pre-stocking, what are companies doing to kind of proactively mitigate this kind of tariff risk moving forward?
They're asking suppliers to basically eat the tariffs, right? Some big retailers have done that, and some companies are explicit. They're taking some price action, like the footwear company that reported last week. It was a U.S. manufacturer of household appliances that was supposed to be a winner in the whole tariff thing. And what happened when they reported is because of the pre-stocking from Asian importers, they actually had a horrible quarter, even had to cut their dividend, right? That was supposed to be a winner. And their stock went down quite a bit when they reported results. So things are unpredictable even for the purported winners.
Besides tariffs, though, Nick, what other topics are showing up in earnings releases and the related filings? Any surprises or anything you'd call out?
It was very surprising to see AI being a big topic again.
Unbelievable. You got to be kidding me.
AI is a very big topic, but it has matured where you don't have general references around AI. You're seeing companies are way more focused now. So if you look at, for example, AIG at their investor day, they showcased their new underwriting system using generative AI. It's a core function that is being developed with AI, very focused as an insurance company on that. In another sector, I really like that quote from Johnson & Johnson that the days of 1,000 flowers are gone. And they had at some point almost 1,000 internal Gen AI projects, and now this is all focused on supply chain, drug development, etc. Merck was in the Wall Street Journal yesterday. Very similar thing, a real heavy focus on Gen AI in drug development, clinical trial data, and so on, rather than 1,000 things. And I think we're seeing that across the board, where kind of comes with the maturity where we'll develop agents that are going to do either focused on our core functions. Interest rates, obviously a huge topic, and just in general, the independence of the Federal Reserve. You had a very unusual situation where the CEOs of the big Wall Street banks came out during earnings season defending the independence of the Fed. And it's obviously there's a lot of pressure from a certain former real estate developer to see rates go down. People still talk about inflation. It never went down to the 2% target. It's closer to 3%. It's probably the new normal. And if you look at, let's say, how Bitcoin and gold have done year to date, they're up 20-23%, unlike the S&P 500, which is up at around 9% or so. I think there is an increasing recognition that inflation will stay elevated rather than go back to kind of what it was after the great financial crisis, kind of relatively low and steady. In filings, we're seeing companies as kind of as a subsequent event discussing the One Big Beautiful Bill Act, which I think should be getting more mileage in terms of especially this, is it next quarter and going forward? Because when you look at kind of the big provisions, you have bonus depreciation, which is a very good boost for cash flow. You have U.S. R&D tax credit, and then on the other hand, you have eliminations of certain things like the executive compensation deductibility, which is sometimes discussed in proxy statements. Similarly, moving expenses also appear. They are part of the exec comp. They're now a taxable benefit if employees are moving, which I think with going back to the office and so on is an interesting element. We're seeing big M&A coming back. There are deals that would have been unthinkable under Lina Khan. And now, let's say there is a fairly sizable railroad deal that was announced very recently that probably would have been unthinkable under the prior administration. And you're seeing also some of the opposition that existed before in court is actually the new administration saying, no, we're no longer opposing these transactions. It has happened twice already on two marquee transactions, one in the networking space, and I'm forgetting the other one. We're seeing, people still talk about GLP-1s and how they're affecting food consumption, though, with the one of the big winners in the pharmaceutical space that became the most valuable European companies, they haven't done as well in the stock market. And the last thing that I'll call out is we are seeing a increased number of companies allocating to Bitcoin and other crypto assets as a part of their treasury strategy. Now, it's the number I saw is around 30 billion announced year to date. And some companies are very explicit regarding that. Yes, we are now, a Bitcoin company, and there is one specific company that is very large as a part of that started buying Bitcoin a few years ago and became very large, and they're issuing all kinds of interesting instruments like convertible preferreds and so on to raise more money to buy Bitcoin. We're seeing other companies that are just saying, we'll buy X in Bitcoin, in some cases, some of the other cryptocurrencies. So that's a relatively new development. I don't think it's going to continue, but it's hot at the moment.
I just point out one of the things that you mentioned earlier in your response was companies talking about they're still assessing the impact of everything going on. And I think the temptation might be, because of the volatility in the current environment, to maybe kick that can down the road just a little bit, like we're still assessing, we don't know how we're going to affect that. And, to me, that's one of the areas where, just speaking from an SEC reporting standpoint, there's probably a fairly significant risk, because the likelihood is that based on all the information you knew at the close of the period, while you couldn't predict the future, you probably had a pretty good idea of what the impact would be at that point in time if nothing else is going to change going forward. And I think, to me, that opens up a question of how robust you're willing to make your disclosures, as opposed to just, talking about an impact assessment. I think there might be a thought that the SEC might be a little more lax, for example, with new leadership. I don't think that's going to be the case when it comes to pretty cut and dry enforcement issues like that. So anyway, I feel like that's probably something that might be worth a call out for our audience. Nick, as we wrap up here, I love your predictions. They're usually spot on. And if not, they were at least very interesting. And we've had a lot of fun with that over the years. Anything else you think we'll be talking about in the second half of the year that we're not talking about right now?
We'll probably see one of those announced trade deals being majorly renegotiated. I think nothing is final, so be ready for fireworks. Very excited about AI. There is, a lot of companies, they're not public companies, but the traction that they're getting, and I'll give you one example, Cursor, which is used by software developers, reached $100 million in ARR in under 2 years, which is probably a record. It kind of signifies the level of adoption, and that we're still early. Like, we haven't yet seen a full-length movie made by AI, right? So that will be, I think, a pretty major milestone. And we'll see more good stories, like expanding access to healthcare is a good thing, and people seeking health advice and to get possible diagnosis and so on. We'll see bad things, like if you thought that radicalization by social media algorithms was bad, when you have a personal assistant who is constantly confirming what you're saying, and then he's telling you it's great, I think it will get worse. And two others. Dubai chocolate is a fad. It will go away. And on the positive side, and it's not a prediction, it was announced in the Wall Street Journal that there will be a Reese's flavored Oreos.
Well, Nick Mazing of AlphaSense, honestly, always so interesting and informative. Thanks so much for joining us.
Thank you.
This September, come together with leaders in finance, accounting, audit, and sustainability at Workiva Amplify. Learn together as experts unpack the latest regulatory shifts, AI innovations, and market trends. Grow together in thought-provoking keynotes and live demos of the platform built for assured, integrated reporting. Innovate together with a look at how connected data and native AI can streamline work and create value. Join us in DC or virtually. Register now at workiva.com/PR-amplify. That's workiva.com/PR-amplify.
Our next guest is Josh Gertsch, Workiva Industry Principal, Capital Markets Expert, and seasoned audit and finance leader.
3 takeaways from his perspective. 1, the capital markets are now trending up after 2 to 3 of the worst years for IPOs. 2, companies waiting to go public should focus on what they can control. This includes refining their equity story and the financial metrics that support it to instill investor confidence. And 3, they should also focus on operational readiness to ensure that all the necessary finance, accounting, legal, and compliance components are ready for the burden of being a public company.
All right, let's get to our conversation with Josh. Hey, before we get started, can you just give us a little bit on your background and how you have come to be kind of an expert on IPOs and capital markets?
So I joined Workiva's capital market practice about 4 or 5 years ago. Previously, I started my career as a CPA. I am a CPA still, and spent about my first decade in my career with KPMG and had a lot of clients that went public or went through a lot of M&A activities. So I kind of got working on deals all the time. Probably have done tens to hundreds of different types of deals that have kind of worked in that space. And then following my time at KPMG, I went out into practice and kind of an accounting, finance leadership role, but I continued to kind of support our deals team or corporate development. They refer to it a lot. And so, we were trying to take our own company public a few times. And then in the meantime, we were always kind of acquiring companies or looking at other things. So just kind of always have been drawn to the deal space. And I started in a market that was heavily active in deals, and it's kind of been there. And it's always what's interests me. I like the energy there. I like the people that we work with there. And so I've really just kind of wanted to continue to be in the space and stayed in it.
Well, I love that. And actually, to your point about a market that's kind of gone up and down, I think we all remember back during COVID when, among all of the surprises, there were many back then, but among all of the surprises, this explosion in capital markets, I think it took me by surprise. I'm wondering, can you talk about that? But then maybe starting from there, where have we gone and where are we at today?
Yeah, I think, latter half of 2020 and 2021, the market was probably the biggest boom we've seen in over 20 years. I mean, we've never had more IPOs than we kind of had in that period for a very long time. And I do think it kind of demonstrates that there's a want to be on the public markets. There's a want to raise capital that way. And there were a few things that enabled people to raise capital quicker, like SPAC entities were a lot of it. They were about half of that, where people could go through. It didn't take as long to get through due diligence. It didn't take as long to get through the filings. It allowed PE sponsors to be able to put up companies that could be acquired. And so it created a lot of activity. The downside of it is when we came out, valuations kind of suffered. The economy level set with COVID a little bit. We started getting back to normal. So following those best years that we had probably the 2 or 3 worst years that we've ever had. 2020 was brutal. 2023 better. And 2024 was a lot better. So it's kind of trending back up. And if you do look at the market, it seems that we go in kind of cyclical cycles of about every 7 years. And so 2022 is kind of the trough. 23, 24 have all been better. And I think we're kind of getting back to a pre-COVID state of looking to hopefully have somewhere between 250 and 300 IPOs a year is typically where that'll kind of sit in a normal year. Now, that said, there's a couple things out there in the economy right now that are probably slowing that down just a little bit. But if those things are removed, then there's a lot of expectation that those numbers will continue to climb and kind of be back to what I would say a steady state or normal state in any given year.
Well, that's just actually what I wanted to ask you about. I have heard similar things and a lot about this pent-up demand or this kind of forward momentum towards public offerings. And it seemed like the sentiment is that, hey, the floodgates were going to open in 2025. We haven't quite seen that yet. What happened?
I think it's hard because to some extent, they have opened to, I mean, everyone expected, okay, we're past 2024 was an election year in the US. So the US markets were kind of holding off on that. But 2025 was like, okay, we didn't see any macro factors that were going to limit it. And given kind of the pent-up pipeline that we had, people wanted to file in 22 and 23 and couldn't get values. And so, they kept kicking the can down the road. So we probably have 2 or 3x in the pipeline that you normally do of people doing it. And so to your point, people have been redditing that like it hasn't slowed down at all. Now we're in a pricing exercise, kind of given the volatility. So there's a lot of demand there. And if the markets have the value, people will execute on it. If not, they'll kind of continue to hold off until those valuations are a little bit more favorable. So it can be a little bit misconceiving because you're like, oh, a lot of things are happening. People aren't going public. But behind the scenes, most people are getting ready to go public. Now we're just waiting on a stable market to price them. And if they can get the values they want, you probably will see an explosion still. It's probably going to be late 25 or 26 if it comes. I think people expected that to happen a lot sooner this year. By now, we expected like, okay, values are there, market's up, all this pipeline, like let's run it through the public markets and go. But because of tariffs and a few other macroeconomic factors, it's caused valuations to stall out, or it's caused the market to be too volatile to actually price at the moment.
Well, you talk about market stability, which, as you also mentioned, certainly not a lot of what we've been seeing lately. How does that impact? I mean, what's the specific problem that volatility poses for raising capital?
Yeah, anything can happen in the economy and the stock market will adjust. Like it'll adjust immediately. You make a big announcement about interest rates or tariffs, and the market is going to like find a new valuation to adjust for those things in the economy. And it does it probably quicker than any other, like capital is incredibly fast at adjusting. And so it does it probably quicker than anybody. So, I mean, the fact that things will happen and the market will adjust, that will always kind of happen. But the problem on pricing an IPO is like you can't have big changes in the stock market on the valuations. So the rule of thumb is if for a period of time, like the stock market is staying where the Dow isn't jumping more than 20%, like the changes, like it doesn't go up 20% one day and 20% down 20% one day. As long as you're within that range of kind of 20%, IPOs will technically move forward in price. Like it's a stable enough market that people can get deals done. The rule of thumb is anything over 20%, no one's going to mess with trying to price in a market like that. When tariffs came out, the market started moving 50%. We're kind of back down between 30 and 40. But until it gets back down to like where there's not a lot of as much volatility, no one's going to do anything on that valuation pricing side. But as soon as it does come in thresholds and we have a period where, hey, we feel it's steady, and if those valuations are favorable, like good deals always get done in a market. Like they'll always be priced right. No investment banker is going to deal with the volatility. There's too much risk in trying to price something that's taken years and years to get ready. They're not going to risk like a huge swing like that in one day. And so they need to know that it's steady enough to handle that. And as soon as we get back to that, you'll probably start to see deals move a little bit more.
And when you say 20%, are you talking about like 20% of the Dow Jones or 20% of the NASDAQ?
Exactly.
Or
like if you wake up and those like that value is changed by like 20% or that high rate, like it's not like, I mean, you're probably going to look at it more like on a sector or an industry level, right? Like if I have a tech company, I'm going to look at like, hey, what are other tech companies trading at? If their trading is changing by more than a 20% rate, I think it's really tough to price it. But to your point, sorry, I was trying to kind of go higher level, but really you would more go towards what's my sector? What are my comparables? What do those exist? And they've got to be trading steadily to kind of give that confidence to investors to move forward to price in a public market.
Got it. Which clearly recently we've seen that kind of volatility.
Like, not only that, it's extremely out of whack. And so like now you'll have this period where people will have to have a fair amount of, it needs to reset. And then we need to know it's reset for a little bit to feel comfortable kind of moving forward again.
Yeah, well, that was going to be my next question. What needs to happen in order for those windows to open up again? So when you talk about like reset, and then I actually love your words, like, and then you kind of have to know that it has reset. Break that out a little more for us.
Yeah. Okay. 2 things I would say have to happen. One, we do need a little bit of clarity on like some of these geopolitical factors that impact the macro economy, which honestly, at this point, it's tariffs. We need to understand what tariffs are going to be so that the market can adjust for them. Once we know that, then once the market has adjusted for that and we have some clarity on what that policy is going to be, it flows through the market, then we just need a time period, and it might be weeks, it could be maybe a month, but like we need a time period where we know that that market has accounted for tariffs and the impact on the global markets or the US markets. Once we have that, we can move forward and people will start to price.
And you make a really good point. I certainly have not been as close to capital market transactions as you have, but I have been a part of an IPO and other secondary cap markets offerings. And it's true. I mean, those things, especially an IPO, takes years and years and years. So you are going to want to wait, we need a high level of confidence that things aren't going to change so that all this work doesn't go to waste. I think it's a great point.
And I do think a couple things. So to your point, it's the market's dead. The market's not dead. The pipeline is still there. And in fact, it continues to grow every day. The question is once the market settles, are we going to have a good enough value in public markets to want to take your company there? And then two, is it stable enough to price? And if it is, that pipeline will unleash and you'll kind of get that explosion. The other thing that people are realizing is, okay, if you price on day one and day two, it goes down, this is a long-term game we're playing. And I think there is a lot more kind of acceptance of that anymore. Look, we price at 50 and it goes down to 45 the next day. It's not the end of the world. This is a long-term game. They would hope to see over the next year that it goes above that starting price, that they have. And if it does, then you continue to get more and more momentum in the markets and more people want to go there to get a return on their investment and price on the public markets versus selling off in a spin or selling to private investors of some kind.
Super helpful and really interesting. Thank you for kind of succinctly distilling this down to at least what I can understand, which, I don't know, maybe that's not the threshold, but at least you've done it for me. Just one last question as we get ready to wrap up here. So if you are one of those companies where you're kind of waiting for that stability, you're maybe otherwise ready to go or at least close to it, what do you say to them? What should they be doing right now?
One is dealing with valuations in the macroeconomy, and we covered off on that. Two is understanding kind of the level of scrutiny of regulation that's going to happen and what it's going to take to get through that process, which is actually very favorable under the new administration. They've gone under deregulation. They've kind of raised the blades on scrutiny on kind of going through these IPOs and what they're looking at. They're trying to speed up the process or bring more people to capital markets. And it's interesting that they're deregulating and then you've got tariffs, which are going against each other. But once you get through those two, there's two things that companies can control, and they just need to focus on those things and let the other things kind of the dust settle on them. And one is what happens when you get into deregulation is, the investors aren't looking at things as much. They're not pressing as much. But what does change is that burden kind of shifts over to the investors, kind of asking more questions and making sure they're more comfortable. So what we call the equity story and the metrics that support the equity story are the number one thing right now. You have got to be succinct in going out there and being hey, what makes our company so special that someone wants to invest in it? And do my metrics, my financial metrics that drive my business, do I understand those and can I talk about them in the right way? If you can do that, you can instill investor confidence. It'll end up getting you a much higher valuation, even a premium to some degree if you can do it. So just being super crisp on what's our equity story? Do the metrics support it? And then, okay, let's run it through the compliance traps of the filings and everything else, but it all kind of supports the right narrative. So one is getting that equity story down flat. That is the most important thing that can happen. And then the second thing is what we talked about is all that preparation we would call IPO, or I would call it operational readiness. And basically it's saying, hey, when you go public, you have to give, there's a burden of uplift, I would call it. It's a finance and accounting stuff, your month-end close, your financial reporting, your tax, there's a burden to get all those things to be able to do them as a public company would. You've got legal and compliance issues you've got to deal with, and then dealing with the investor relations and communications and PR side of the house. Now get those things ready, make those investments, be ready to operate as a public company, have that piece done. Continue to refine that equity story. And if your metrics are good and your business is doing good, as soon as there's an opportunity for good valuations on the public markets, you'll be able to capitalize them. But focus on what you can control and let the other stuff kind of sort of sell out. And then they'll be fine and they'll do really well if they can kind of get through those components of it.
I love those takeaways. Thank you, Josh, for breaking this down for us. We appreciate you having thank you, Josh Gertsch, for breaking this down for us.
You're welcome for having me.
Having you.
No, thank you. I appreciate coming on, and thanks for the opportunity to kind of share some insights on these things.
88% of global professionals say AI is already driving ROI. But here's the catch. only 1/3 have the data quality to use it well. In Workiva's latest Global Practitioner Survey, 2,300 finance, audit, and sustainability pros shared how they're building value with AI amid uncertainty, with faster outputs, fewer manual tasks, and more strategic focus. You'll see what's working, where gaps remain, and how data integrity separates the leaders from those lagging behind. Read the full report at workiva.com/PR-building value. That's WORKIVA.com/PR-building value.
Thanks again to Nick Mazing and Josh Gertsch, and thank you for spending time with us on the pre-read, brought to you by Workiva, the world's only unified platform for financial reporting, sustainability, and assurance.
We've got more sharp takes, global insights, and bold conversations coming your way. So be sure to follow or subscribe on Apple, Spotify, YouTube, or wherever you get your edge.
And if you like the show, leave us a review. Send it to someone who loves a good footnote, or just shout it out on your next team call. We won't mind.
We'll be back next week. Until then, go lead it like you mean it.